and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. I'm your host for today, Stephen Irwin, investment advisor based out of our Belfast office. And this week, I'm pleased to be joined by Richard Carter, our head of fixed interest research, and Billy Ewins, one of our research analysts. Good morning to you both. It's been a busy few weeks for markets and macro, and with geopolitics once again taking center stage, the Greenland standoff, shifting tariff threats, and rapid reversals have all been whipsawing risk sentiment. Currency markets have had their moments, with the US dollar softening, and at the times the yen has had some sharp bursts of strength. But it's the commodity space that's really stolen the spotlight over the last week or so, with precious metals and silver in particular experiencing some extraordinary volatility. More broadly, we're seeing a noticeable tilt towards economic nationalism, especially as the US trade conflict continues to reshape thinking around economic security, supply chain resilience, and long-term strategic priorities. Richard, let's kick things off with Greenland. It's been at the center stage of a pretty remarkable bit of geopolitical theatre recently. From where you sit, what's really driving the US interest here? Is it Arctic strategic positioning? Is it access to key resources? Or does it just feel a bit more like high stakes negotiating move?
Well, I don't think if Trump wasn't in the White House, I don't think this would be really much of a topic for the United States at the moment. Any more sort of sensible mainstream president probably wouldn't be making much of a fuss about Greenland at the moment. I mean, clearly there are some long-term kind of mineral attractions of having an ownership of Greenland. There are clearly some sort of security interests at play, but those seem to be a bit of a red herring, given the US has got bases there anyway, and sounds like they've got the right to do pretty much as they please on the military front. If they want to put more resources there and set up more bases, they can do so. I think with Trump, his attention just goes from one thing to another, sometimes by the hour, sometimes by the day, and it was Venezuela for a bit, and then it moved on to Greenland. And I think he just likes the idea of the US becoming bigger by acquiring more land. It might be Greenland this time, Canada another time. I think the whole thing was basically just sort of vanity and a bit of a real estate thing for him. I mean, there are clearly serious issues at play here, but nothing that can't be resolved within a sort of NATO framework. So I'm glad to see things have moved on a little bit. It looks like the EU and Denmark, some of the other countries standing up to the Americans has kind of worked, and hopefully things will move on from here.
And then sticking with the US and the dollar theme, the US administration is still very focused on reshoring manufacturing and boosting domestic industry. A weaker dollar certainly helps with that. We've seen the dollar soften quite a bit over the past year. Do you think that trend is further to run?
Yeah, it might well do, given that Trump's going to be around for a while. Although we shouldn't forget that the US economy is growing pretty strongly, certainly compared to some other parts of the world, including maybe Europe and the UK. So I think there are still some significant attractions to the dollar. But yeah, some of the weakness is understandable. The policy making, not just around Greenland, but a few other things, is so unpredictable at the moment that it does make you a little bit nervous about US assets and the whole thing around Fed independence or the rest of it. We can come on and talk about that. But you're right. There was a sense that a weak dollar is good for getting sort of sorting out some of the trade imbalances. And they had this thing a week or so ago that the US was maybe going to intervene in currency markets to sell dollar and buy the yen, and that got people speculating they were really in favour of weak dollar policy. But since then, Scott Bessent has sort of come out and said that we don't really want to see any major moves, and we still support a strong dollar. So as ever, Trump does one thing, says one thing, and then the rest of the administration has to scramble around and make up for it. I doubt they want to see any massive moves in the dollar, but as long as Trump's there, you wouldn't bet against some more weakness.
It is. It is super interesting. We've also seen that President Trump has nominated Kevin Warsh as the next Fed chair at the end of last week. I found it quite interesting that the prediction markets, like poly market, moved even before the announcement, which does raise some eyebrows about how people were profiting from privileged information. Richard, how do you think markets are reacting to the new Fed chair, and to what extent do you think this has driven the sharp sell-off in precious metals?
Well, there's been a lot of speculation about this, and the worry for the market was that they would go for a kind of non-mainstream choice, who would basically just do Trump's bidding, lower interest rates, and you'd really have the whole Fed independence thing called into question. And that, treasuries and things like that, a dollar, they're the bedrock of the financial system in some way. So it was a pretty dangerous thing. And the move we've seen in gold and silver, I mean, clearly there's some massive speculation going on there as well, but there are fundamental reasons for it, say US policy making and geopolitics and the rest of it. So Kevin Warsh is a pretty mainstream appointment, actually, and I mean, you never know what his views are, when he starts the job, but his history has been sort of relatively hawkish and also not really in favour of QE and things like that. So I think markets have taken it in a sense reasonably well, that this is not a sort of crony who's been put in charge of the Fed, but that's had consequences for that gold and silver move. I mean, the moves we saw were just, probably a bit ridiculous and overdone anyway. So there was always a chance that they were going to unwind, but this was the sort of catalyst for it. Maybe, markets thinking actually the Fed, is still going to be relatively hawkish, sensible guy in charge, and that was an excuse for a massive unwind of those popular trades. So so I definitely linked to it, but we'll just see what Warsh does when he actually gets into the job.
Yeah, some of the moves were extraordinary. I think on Friday, intraday silver was down 34% at one time. So, I mean, that is record breaking in itself. It's something like the Hunt brothers from the 80s. So it'll be interesting to see when the dust settles if there was any exposure, or if anyone was exposed to that and was a forced seller into a liquid market that really driven that down. I want to pivot here and spend a little time talking about Europe, and more specifically the European equity market. Last year was the first time in quite a while that European equities outperformed the US on a currency-adjusted basis, which is noteworthy in itself. A number of factors sit behind this, but a major one has been the decisive change in Europe's fiscal landscape. Many EU countries have been wanting to loosen the purse strings for years, but the real turning point came when Germany effectively removed its long-standing debt brake. And it is quite interesting, as Germany managed to hold the line through the EU debt crisis, COVID, and Russia's invasion of Ukraine, yet it was geopolitical pressure, including tensions with the Trump administration, that finally nudged them towards a more expansionary stance. Billy, you cover Europe as part of your regional remit. Can you give us a sense of how this renewed fiscal spending is feeding into the economy, and where, in practical terms, the money is actually being deployed?
Yeah, I think what's different about this year in Europe is that fiscal spending is no longer just the headline that it was last year in 2025. Now it's really showing up in very real areas of the economy. The clearest example is German defense spending, which has stepped up meaningfully with procurement running at record levels. This is flowing directly into defense manufacturers, industrial components, and broader supply chains. Beyond defense, a lot of that fiscal impulse is going into strategic autonomy. And what this basically means is investment in energy infrastructure, utilities, grid upgrades, and materials, as well as parts of telecoms and transport. The caveat is that these are long duration projects, so the money doesn't hit GDP all at once, but what it does do is create sustained demand across industrial and cyclical sectors in the region. What is probably less well known is the ongoing policy work at the European Commission level. Initiatives like the Savings and Investment Union are trying to mobilize huge amounts of cash under the mattress and redirect it into new tax efficient accounts, much like the US 401k structure. At the same time, policymakers are taking a firmer stance on trade practices, for example, through measures such as the EU Steel Action Plan, which directly supports domestic producers. All of this feeds through to the real economy via higher order books, better visibility on capex, and improving confidence. The beneficiaries seem to be domestically exposed companies rather than the exporters, which is why we're seeing a very clear domestic exporter tilt in earnings expectations. The key takeaway overall is that this is very targeted stimulus. It's flowing into defense, infrastructure, energy, materials, and industrial capacity. And this is exactly where we are seeing earnings momentum pick up.
Thanks for that. And looking at the numbers, and correct me if I'm wrong, Billy, the Stocks Europe 600 index delivered really strong returns last year. It was up over 27% in sterling terms and has continued to hold up well on a relative basis year to date. From where you sit, do European equities still stack up well on a relative basis?
Yes, European equities do stack up reasonably well, but the drivers of last year's returns, as well as what matters from here, are different. A huge part of last year's great performance was driven by multiple expansion, sort of a liquidity rally and a re-rating of specific sectors rather than broad-based earnings delivery. Returns were highly concentrated with banks, defense, semiconductors, and utility stocks accounting for a disproportionate share of gains at the index level. So this was a very selective market willing to pay up for inflation protection and fiscal visibility, rather than one with a uniform acceleration in earnings across the board. That level of concentration does matter because it makes the index return overstate the breadth of the underlying fundamentals. Earnings momentum is now improving, particularly in cyclical sectors, and this is the 2026 story that we're actively following. Looking forward to this year, valuations in Europe are no longer outright cheap, but they are still undemanding relative to history in other regions. The market trades around long-term average multiples with no obvious excess despite strong performance. Europe also continues to offer an attractive income profile, dividends and buybacks providing a meaningful component of total return, especially in a higher for longer rate environment. I think where Europe really stands out is in its sector composition. Around 60% of the index is cyclical, which means the region is structurally geared to a reflationary, or for want of a better word, Goldilocks macro outcome. With inflation cooling, growth holding up, and fiscal support intact, that cyclical composition remains supportive, even if returns become more selective and less index-driven.
Thanks, Billy. And I know you've already touched on this just there now, but Europe, a bit like the UK, has quite a heavy tilt towards what we'd call the more old economy sectors. That's like energy, materials, industrials. How have different investment styles been performing in this environment? And what do we consider when we are building our European exposure here at Quilter Cheviot?
Yeah, it's a great question. So over the last year, the market has very clearly favored value over quality and growth. And we think that that dynamic will likely continue to run. So as I touched on, just a moment ago, we're in a reflationary environment and that naturally supports cyclical and value-oriented parts of the market. So while quality has rebased, we still expect value to lead this year. Last year was actually quality's worst relative performance in around 20 years. Since then, quality has derated back to long-term average valuations, but we'd frame that as a normalization rather than a fresh opportunity. It's no longer expensive, but we also don't see obvious near-term catalysts for a sustained re-rating. The reason for that is fairly straightforward. Quality is a low beta factor, so it tends to do best when growth is scarce and earnings are hard to find. Right now, that's not the backdrop. Growth is broadening, economic surprises are generally positive, and inflation seems to be cooling without collapsing demand. In that kind of environment, the earnings scarcity premium that supports quality starts to fade. You can also see this in how the rally has behaved. Strong equity markets typically work against low beta styles, and we've even seen last year in particular a sort of dash for trash rally where lower quality companies are outperforming, even while quality businesses continue to rise in absolute terms. Another important point is that traditional definitions of quality are breaking down. Sectors like healthcare, luxury, and staples, which screen well on ROE, return on equity, and balance sheet strength have seen earnings downgrades. Meanwhile, financials and industrials are leading upgrades, so earnings quality today is showing up more in revisions momentum rather than just the traditional metrics of high ROE and low leverage. So, late in a cycle, lower quality stocks often derate sharply and look extremely cheap, which makes quality look expensive by comparison. This time, however, it seems to be that cycles are shorter and less severe, and many lower quality companies are being priced based on the assumption that they can stay profitable for longer. That means that they haven't sold off in a way that they normally would. So quality hasn't become cheap because everything else has collapsed. It has simply derated back to normal levels. So, for this reason, we do not think it's an especially compelling time to be adding to quality stocks today. So, the important question, how we're building exposure in Europe this year, the answer is we're leaning into value, cyclicals, and maybe even some select small caps. This is where valuations are reasonable and earnings momentum is improving. At the same time, we're very conscious of crowding. A lot of recent performance has been concentrated among AI beneficiaries, perceived fiscal winners, and inflation hedges like gold. These are all structurally attractive themes, but at the margin, they are crowded trades. What we are hearing from managers and where they are finding the most interesting opportunities is in less crowded and less correlated cyclical niches where expectations are realistic and the upside is coming from fundamentals rather than just multiple expansion.
Thanks for that. I think it really does highlight the need for style diversity, and then obviously where we can lean into particularly interesting areas. But for the interest of time, I think that that'll wrap up today's discussion. So thank you, Richard and Billy, for your time and sharing your insights. I hope you enjoyed today's discussion, and we do love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week, and in the meantime, head over to our website at www.quiltercheviot.com, where you can read the company market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have a question that you'd like to ask one of our experts on our next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's us for today. So thank you, Richard and Billy, for your time, and for all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.